So, welcome back to another episode of the Risk Podcast. Today, I'm joined by Vishwas Khanna. Vishwas is one of the partners at Avantage Reply, and before joining Avantage Reply, Vishwas was a director at Deloitte UK. He has deep international financial services consulting and risk management experience, a long history of leading teams and complex risk transformations for wholesale investment, retail challenger banks, as well as FinTechs in the UK and across EMEA. Alongside this, he's also a non-exec director at a mental health charity based in Edinburgh. But Vishwas, if you don't mind, for the listeners' sake, could you please just tell us a little bit more about yourself and your background?
Sure, and thanks, Nader, for inviting me to this podcast. Very happy to be here. Um, so, over the last 15 years, I've worked primarily in financial services, focusing first. The first part of my career was with Morgan Stanley, working in the prime brokerage risk space, and had the fortune of seeing the financial crisis firsthand in 2008. Moving on from there, moved to consulting world back in 2011, started specializing on the risk and Basel side of things. And then over a period of time, started building experience under the prudential risk regimes, new firm authorization, fintech, and much broader programs, including on the way, covered Brexit transformations, risk operating model transformations, and so on. So it's been a good, exciting journey. And as you said, one of the things that outside of my work, I am a non-exec with a mental health charity based in Scotland, Miracle. Very, very fortunate to be a part of that team who are working on a number of initiatives. And I think their work is particularly relevant in these times when all of us are grappling with not only physical health, but mental health issues. So very, very fortunate to be there. Lastly, I'm also a volunteer with English Heritage. So of the three components of my life, my professional life, in stacking order of happiness, English heritage work gives me a lot of happiness as well. So that's about a brief background to me, and as I said, very happy to be here with you and having a chat.
That's great. I mean, to be honest with you, it sounds like you have more hours in the day than the rest of us, but I'm sure you just manage it better, which
I would
something I'm
like
very jealous.
we're fine, yeah.
But touching back on that journey, just looking at 2020, obviously it's a tough and challenging year for, a lot of people. But in terms of, if you can give us some context of 2020 and what happened to the risk functions.
Sure. It's of course a broad, sweeping question in a way. 2020 has been a seminal year, I would say, in terms of how not only our professional lives but our social lives are impacted. But going back to the question that you've asked, how did risk functions respond to the things that happened in 2020? And more broadly, how business responded, I would say. And I'm focusing here on the financial services side of things because that's where I work. I think there were some good parts here in the story and some to be enhanced parts in the story. As the disruption from the pandemic hit organization and risk functions, there were three or four things they actually did quite well. From a continuity of service perspective, that's number one. Continuity of service, most financial firms in the UK and broadly in Europe and globally were able to switch to remote working in a fairly seamless manner. If I give you some statistics, the initial expectation of most firms, the consensus view was that if we have to switch to a fully remote working environment, we have a program of 9 to 12 months ahead of us if we want to do that. What the pandemic did was people had to react quickly, and the average time in which most financial firms became fully remote or near fully remote was about 11 days. So that tells you from a continuity of service perspective, people were able to switch quickly, risk functions were able to respond quickly, and come online in a way that did not disrupt the servicing of customers ultimately in the market significantly. I think that's a big achievement for risk functions and for financial services in general. The second big aspect was continuity of lending, continuity of credit in the economy. In the past financial crisis, service continued, obviously, because this was not a pandemic before, but credit took a hit. Credit facilities were slowing down, transactions were slowing down, and so on. but driven by government initiatives, driven by unprecedented levels of liquidity in the system, credit flowed, transactions were happening, and real businesses were still being supported. For risk functions, what it meant was they had to process a lot more of transactions, not only from a disbursement side, but also from a funding side as different funding schemes were launched. And to assess risks in that environment, to still be able to make those loans, to still be able to have those large counterparty wholesale transactions, I think that was a massive achievement. The third big thing that I would think happened was the pandemic, as is oft said, it compressed years of change into weeks. And most risk functions started adopting technology a lot faster, moving on to more newer programs of implementation, looking at automation, looking at artificial intelligence a lot more closely. And I think all those three things are particular successes of risk offices, risk functions, and broader financial services businesses. On top of it, I'll add one more thing. One of the things that financial services firms have done well and risk functions have done well is how they manage the transition for their people and their teams. Teams suddenly became dislocated, became fragmented, but newer lines of communication were opened. More intensive engagement was created. And I can say this based on my interaction with CROs over the last year and how they've instituted change in their own organization. Uh, People engagement has become one of the most priority areas for them. And in the short term, and we'll come to the long term aspects, in the short term, I think that's also a success for risk functions. So that's the good side of the story for what has happened well with
So
businesses.
what went wrong then? Where did they fail?
So from that perspective, the most important thing that comes to my mind is risk functions had a singular failure in being unable to predict a circumstance like this and being prepared for it. Now, it's not to blame somebody for saying that you didn't predict the launch of the Apple iPhone in 1999. We are talking about very core concepts of risk and uncertainty out here. The pandemic, while we've talked about it, it's imminent at some point in our lives. It was still a very uncertain event that you can't quantify for properly. But when we ran a survey last year, less than 1 in 15 CROs suggested that pandemic risk was even on their radar at any point in time. So there was, I would say, an industry-wide, a society-wide failure to accept that risks and uncertainties that might be too far off in your data points might still exist and might still impact us. And I think that is a critical failure. Not to say that risk functions only were responsible for it. The second one, I think, is from a more longer term perspective, the success of risk functions was not determined by them adhering to a script that they had and they followed that script in the pandemic and everything was fine. It was driven by the fact they had no script that was ready for this environment. They wrote that script quickly and moved on. What that means is that previous ways of working are not relevant anymore. And now firms will have to redesign how their operating models would actually work now. And that is a massive learning from this pandemic because firms now need to invest in the whole, I would say, reorganization of how they work, how they process information, how they escalate issues, how they govern an organization, and so on. And that, I think, in the short term, they might have done well, but in the long term, there are systemic issues that need to be addressed in that and that sort of things. And finally, what didn't happen very well, I would say, and there's a chance of things going wrong further on. The increase in credit delivery over a period of time, of course, it was supplemented by government funding. It has created the potential for massive insolvency risks on the credit side in the books. And I don't think that firms have taken proactive steps to understand that risk profile that's coming to hit us in 2021, 2022. It's an issue that's been discussed at length, but most firms don't have a consensus around how to approach that problem. How do we adjust our credit models, for example, to look at how insolvencies might impact us in the next year? How do we make decisions about lending, for example, in this environment, while being cognizant of our broader societal responsibilities or our obligation to customers? I think that's an answer that was not fully resolved in the early stages of the pandemic, and there's still not an answer. So I think there's more work to be done there. So that's my view on some of these issues. This is not a comprehensive view, obviously, but I think it gives you a sense of where things are going right and where they're not working.
Yeah, I mean, I think it was fairly comprehensive, and it's not only is valid viewpoints there, but it is an interesting take on the fact that there wasn't a handbook to tell everyone how to deal with the situation. So having to kind of react, upon impulse and put people first seems to have worked well, and then that seems to be the best way to go. So
I'll give you an example of how different some approaches were actually. One of the banks, fairly large wholesale investment banks, um, even before the government mandated lockdown, 3 to 4 weeks before that, they had their plan of saying, we need to react to the situation. We need to create team ABC, build a rotational structure as to who comes in when. And then within 2 weeks, that was thrown and said, nobody comes in anywhere. Everybody works from home, except a very minimal number of critical staff, for example, people who need access to the trading floor and the broadband doesn't work and so on. They need to be here. But apart from that, everybody stays home, everybody works from there. Opposite side, I'm aware of one firm where people organize the floors in a way that we have our temporary residents now in the office, we have tents, and the 50 people that need to be here will remain in the office and they won't go home. So clearly, that was not part of their operating manual in 2019. It was developed off the cuff, but it worked clearly. So there's a variety there of how firms responded to that situation. None of it was driven, as I said, by a script. The script was created, and some scripts were very successful actually. But whether they'll remain successful in the long term is the question that needs to be answered. And there are discussions around that, obviously.
well, we're going to touch upon that later when we look at people dimensions and collaboration in that environment, and what was done right and what wasn't. But before we do so, just looking at other kind of recent conversations I've personally been having across the industry, I want to touch upon climate change. It remains one of the most talked about topics. So why is this so important at the moment?
I'll go back to the initial observation I made about risk functions not being completely geared to forecast uncertainty in material ways. Climate change by itself is not a new phenomenon, obviously. Um, what makes it unique is it's what you call a meta risk, a risk that impacts every other risk type in a meta sector, which is the financial services industry. Financial services industry provides credit, provides services, provides transaction capabilities to nearly every single person in the UK and outside. So it impacts the performance and the running of every single other sector, whether it's telecom or airlines or whatever. Flow of credit is what keeps things going. Within that, climate change, because it impacts every sector and it has a nuance or linkage to every other risk. So, for example, if you have uh, lending exposures to beach houses in Brighton, which is where I know somebody stays, uh, those beach houses are impacted by rising sea levels, and therefore you might have an increase in credit risk on your book that those facilities might not be paid because people out there are unable to service their loans over a longer period of time and the value of the collateral is going down. So credit risk is impacted, but equally, market risk is impacted because of future expectations about what climate change risks might do to individual markets or segments. So interest rate movements or equity price movements are driven by that. So why climate change becomes quite important is because it works on multiple levels. It's not a singular risk and it doesn't impact one sector of the economy, but the sector it most impacts in turn impacts the rest of the economy. So it's a layer upon layer. Within that context, I think what's become apparent over the years is that sometimes regulators do need to take front and center action to force firms to think in a certain way. Firms in the oil and gas industry have always been thinking about climate change because that's bread and butter for them. That's what they're directly impacted by. Financial firms have come later to the party, but they are very clearly getting onto the understanding that we need to manage climate change risk in all its forms, whether it is the physical risk of stranded assets, flooding in a city, or flooding of collateral property. versus the transition risk of what happens when policy changes and new caps on carbon emissions come in. How are some of our counterparties impacted? How are some of our relationships impacted, which are dependent on fossil fuels? Do we have massive exposures there, and so on? So climate change, therefore, acquires an urgency. And finally, of course, at the end of the day, we are still living on a finite planet with a finite set of resources. And there is near unanimous consensus, despite deniers, that climate change is real and it is impacting us on a day-to-day basis. So there is no way that financial services firms can ignore what happens on their watch when it comes to climate change.
Well,
So
you touched, sorry, no, yeah.
yeah,
I was going to say you've touched on it briefly there, but there is an impact on financial risk when it comes to climate change, both credit and market risk, as you mentioned. So, looking specifically at that, what can financial services firms do going forward?
most financial firms are doing a lot at the moment now when it comes to climate change, and there are a number of things firms are expected to do, right from changing their governance arrangements or instituting the right governance arrangements that take care of climate change risk at the top level, to analyzing the impact of climate change on their business model, their viability, their strategy, the markets they enter into, the products they work with, the counterparties they deal with, the sectors they get exposed to, and how does that whole flow through look like? So there's a massive amount of scrutiny that firms are applying to their strategy over the next 10, 15, 20, 30 years, because climate change is not a short term risk, it's a long term risk. And some of the um, impacts only become apparent in the much longer time horizons, for example. So governance is one aspect of what firms are changing or looking at, including identifying senior managers who are responsible for looking at climate change within their firms. Um, stress testing, scenario analysis of the portfolios to say what will be the potential impact of a 2-degree rise in temperatures across the globe for us. What will be the impact on us if we are financing trade finance deals which work between China and the UK, and China has a certain amount of fossil fuel dependence, for example. So governance, business model assessments, stress testing, and finally disclosures. There's a huge amount of emphasis by regulators to say we need to know more about what firms are doing in relation to climate change and mitigating the risks arising from it. So whether it is banks who need to make who are required now to make additional disclosures, to asset managers, to insurers, what are you doing in that space? How exposed are you? That needs to be known. And it's not only a financial matter at that point in time, it broadly then combines with the considerations around the ESG risks, environmental, societal, and governmental considerations, because it's not just a matter of financial risks out here. It impacts societies and livelihoods in a much more fundamental way. So a number of large firms are quite ahead of the curve at the moment, but probably not enough. They've, of course, you might have read about recent pronouncements about investors asking a particular globally systemically important bank to make more
Yes.
disclosures on their exposures to climate change risk. So this is a journey that's started. COVID slowed down to a certain extent the emphasis on climate change because there was immediate focus on managing the pandemic. But the story is here to stay. Regulators are keen, including the US. With a change in the administration, the focus is shifting back to climate change. Even with the departure of Mark Carney here, the Bank of England remains focused on climate change with Andrew Bailey. So we do expect firms to be doing more and to be expected to do more in the future.
It's interesting what you said as well about the kind of the ripple effect of it all. It's not just going to impact financial risk, but looking at ESG and further wider environmental impacts. For that reason, it needs to be taken seriously. So, no, very useful viewpoint. So, just to kind of round up before we look at people dimension and collaboration in the workplace. So, looking at the year ahead and the learning from the 2020 experience, shall we call it? What are the key priorities for CROs in 2021?
So we've been working on our top 10 priorities for CROs for 2021. We've engaged with the industry. We've talked to a number of CROs, discussed these issues. And And we've come up with a list of 10. Of course, they can be longer, but in terms of priority, we think there are about 10 key issues that CROs, chief risk officers, need to grapple with this year. Within those 10, we break them down by the strategic high level issues and the more technical risk specific issues. I won't talk about all the 10, but at the strategic level, I think one of the most important ones, which I alluded to earlier, was how do we need to redesign our operating models within our organizations, how risk, finance, treasury, front office businesses, third lines come together horizontally, which is left to right, from first to third lines of defense, and vertically from bottom to the top layers. How do we need to re-engineer that? Because in this environment, with physical dislocation, with us being in different locations all the time and conversing through remote environments, communication paradigms need to change. We can't rely on the same old packs which are produced on a monthly basis and going through channels and review processes. We need to make it a lot more agile. We need to rely a lot more on technology. So operating models is a big piece that risk functions need to invest in and financial services firms broadly need to invest in. The second one is around automation and artificial intelligence. This pandemic has made a significant case for acceleration of initiatives around that. A number of firms have relaunched their journeys on the cloud infrastructure implementation side. A number of them are looking at more automation in the processes, including from credit origination to disbursement and so on. And that journey is only going to continue. We need to manage that story a lot better. The third area I would like to call out, which we've not discussed earlier, but is really important at the moment. When your work environment becomes more fragmented, the attack surface from a cyber vulnerability perspective rises. Earlier, you were 500 people in one bank environment working together. Now you are 500 individuals working in different places. So your vulnerability to cybercrime rises significantly. That as a theme is borne out by the facts for the last year as well. The number of cybercrime attempts from a financial services perspective skyrocketed last year, both in the UK, EU, and other jurisdictions. So from a technical focus area perspective, cybercrime, KYC, AML, how to manage those processes in this environment will become quite critical. Some of the challenger banks, FinTechs in the UK and globally, have been doing a lot of fascinating work on KYC AML processes, making sure entirely remote onboarding can happen, and that has to be spread across. That has to go in nearly all your processes. So KYC AML, financial crime will be key areas of focus for this year. And lastly, one more area I'll call out is, as I mentioned earlier, is around managing your credit risk, your collections processes, your provisioning, and your credit risk modeling. Those will be critical because many firms are looking at significant challenges when it comes to their credit risk assessments and their capital computations. So looking at how to manage that process, how to mitigate against significant spikes in capital requirements, I think that will be a key area. Of course, if you want to have a more detailed discussion on all the 10 areas, of course we can do that on a separate occasion. But I just wanted to highlight some of the big ones that are immediate.
No, absolutely. No, definitely. I mean, we've had these conversations in the past, but definitely worth having another catch up and looking at that again. I think in terms of the credit risk and the modelling piece, we kind of saw that at the back end of last year. From August time, they had to kind of take action, and a lot of the banks wanted to get everything in place, in readiness for 2021. So, it's interesting to see that's going to continue. But yeah, no, thank you for your view on that. And finally, just to touch on this part, it's vital, it's important, and it's more paramount now than ever. People dimension, collaboration, inclusiveness, they're all fundamental factors to any successful team. You're a leader, you've built and developed teams over your career. So in your view, how do you think this is best achieved?
I think what the pandemic has taught us more than anything else when it comes to people management is disruptions like this have a significantly disproportionate impact across various segments of our teams, our workforce, if I may say so. And statistics bear that out. During the pandemic in the UK, women have been disproportionately impacted, whether it's through furlough schemes or layoffs or additional working hours or taking up more responsibilities of the home environment. They've been disproportionately impacted. The more junior staff, more the start out generation, they have been more adversely impacted than the middle management or the senior management. So within our workforce, our teams, uh, different segments are disproportionately impacted. And to a certain extent, it provides us with opportunity to see whether we need to do more to bring about a certain balance in how our teams are run, how people are communicated with, how people are engaged with. And and I think the two key areas which will form the currency of how teams are managed are going to be empathy and trust. For many organizations, people didn't want to do remote work before the pandemic because they didn't trust their people enough to do the right thing, to work in a remote environment effectively. Secondly, people didn't have the right level of empathy for the personal lives of individuals and how they manage their personal lives with the professional obligations on an ongoing basis. The pandemic has brought that into sharp relief, obviously. So one of the critical things for us to do as teams would be to make sure that we have the right level of trust, loyalty, engagement, transparency as we go on. And there's a right level of empathy that is being shown to people who are managing complex lives in a complex environment with all the attendant mental health issues that we've probably just referred to. What this pandemic again makes me realize is that as individuals, we had outsourced so many aspects of our lives to so many different individuals, and suddenly those outsourcing links are snapped. You can't go and meet friends for just to just have a good time. You don't have all the things that you're used to, whether it's access to services or goods. All those aspects of lives are taken away. So you do a lot more of your life. You perform a lot more of your life yourself. And unless leaders and every individual team member show empathy for the other team members, to what they're going through, what their experience is, it will be very difficult for people to come together, have a shared vision, a shared culture. And I know these words can be hackneyed, or they can be seen to be, you know, you can't describe them. They're quite vague, actually. But culture matters in these situations. Do we as individuals feel part of a broader organization still in this environment when we've not been to the offices in a year? Are we still comfortable that we are brand X, brand Y? Do we have a way of working which is different from others? What will attract people to our firm versus other firms in this environment? Because branding changes in this environment, obviously. If you are going to be plugged into a laptop for the next 1 year, does it matter where you work? Questions to be asked. And that's where I think whether leaders and each team member expects a certain level of trust and displays that level of trust, and whether they show the right level of empathy for individuals who are disproportionately impacted, that will be, I think, critical to building a successful teams for the future.
I like that a lot, actually, and it has come up in conversation. And the 2 points that really stood out there for me were the transparency and the empathy part of it. So to allow people to be transparent, because they can't necessarily kind of, like you said, go out or just detach themselves. To be able to be transparent with their colleagues, with the higher ups, from the top down, there has to be that level of empathy, and it's more than just a word or a worthless platitude. It's actually actionable empathy. So no, that's definitely
No,
interesting.
absolutely. In fact, the point that you just raised, this environment has, I would say, created opposing forces sometimes. In a way, if you think about an organization, let's say a new person has joined a bank and they've just come in a way, it has increased access of the most, the youngest people in an organization to the more senior people. You can now peer into the home office of the CEO on a call, which you never did before. Obviously, you never knew how the senior management in a way lived. Now you have the access, and that's a great thing. You can communicate across boundaries and across levels. On the flip side of it, the fact that you can't talk to different members of a team in a physical space, You have to have an appointment. You have to have a call to be able to do that. You can't just walk by and see somebody and have a chat. That increases the distance that you have with your organization. So in a way, it has brought people closer together. Obviously, we are now talking to people we would not talk to otherwise, except once in a year. But equally, it's created that distance from people. Um, and while it works in the short term, in the longer term, what does that mean for uh, appraisals? What does it mean for performance? What does it mean for loyalty? Uh, what does it mean for gratitude between individuals? To be seen. I think there's a long story out there
Mm.
which needs to be solved for.
No,
But
absolutely, yeah. And I think taking those small steps and those small actions you just mentioned, I mean, it can only help, right? So it'll allow that transition as we carry on through this phase to hopefully be less strenuous on people, and they can in turn be more productive, happier, and look after their mental health. So it's a really interesting viewpoint, and thank you for that and breaking it down into the different elements. I'm sure that'll be useful. So really, really useful. I mean, thank you so much for joining me today. It's been great talking to you. We've covered so many points, but I'm pretty sure we can talk for another couple of hours. So we might have to do another follow up. But again, thank you for coming on, sharing your insights. And I'm sure our shared networks will value this. And if anyone has any follow up questions, around the risk parameters or even the people dimension piece, Vishwas has kindly agreed to follow up with another episode or just answer your questions directly. So please drop us a message and just follow our page. So thank you all for listening, and we'll see you again soon.
thank you. See you then.